Welcome to this edition of Credit Matters Today. I'm Matthew McAdam, Associate Director of Communications at Standard & Poor's. Joining us today to discuss expectations for the next round of global climate change negotiations in Cancun and some of the building blocks that will need to be in place for a successful outcome is Michael Wilkins, Global Head of Carbon Markets at Standard & Poor's. Mike, thanks for joining us.
Pleasure.
Start by setting the scene for us. What are some of the key issues that are going to be on the table in Cancun?
Well, the expectations for Cancun are considerably lower than they were for Copenhagen last year. I think the expectations being so low, anything that does come out of Cancun, which is even a minor success, will be well expected, and it will show that there really is some hope in terms of achieving some climate change deal. Saying that, there are some things which are already being expected to be achieved. For example, there's some modest progress which will come in terms of the financial aspects, which were the foundations were laid originally in Cancun through the Copenhagen Accord, which some people think of as being one of the major successes of Copenhagen, and probably the only one. And that was because, for the first time, countries agreed to try and limit their emissions to a point where the global climate was not going to raise temperature above 2 degrees, and that was a major milestone. And also because, on the financing side at least, there was a pledge made by developed countries to raise up to $100 billion per annum to help developing countries adapt and mitigate against the effects of climate change. So that was the pledge made last year in Copenhagen, but now the real challenge is to try and put in place a financial architecture to achieve that fundraising, and how that's going to be done is going to be one of the major issues.
So capital markets clearly have a big role to play in unleashing a lot of this capital and funding the transition to a green economy and investment in low carbon infrastructure and technology. A lot of the work that you've done throughout the year, though, has shown that there are some pretty significant barriers to attracting institutional investors to this space at scale. Yeah,
I mean, it's a huge sum of money, 100 billion per annum, and if you think about where that money is going to come from in the current environment, and it's very hard to see public finance being a major source. Governments are struggling with deficits and trying to cope with the impact of rising debt levels. So raising that kind of financing for helping developing countries mitigate against climate change, which the impact won't be until 20, 30, 40 years out, is a hard sell to the electorate. So the idea is that the private sector is going to have to help out somehow. And by private sector, that's usually a code for institutional funds, pension funds, asset managers, the capital markets in general. And there is appetite out there. Standard & Poor's held an investor roundtable back in the summer of this year, where we found out that investors were interested in putting their money into structures where they could help provide the funds for tackling climate change through environmental investments. But at the same time, they wanted to make sure that the policy environment was correct and the risk-reward balance especially was correctly balanced. And that still needs to be shown, because at the moment there are a number of proposals, but they're not very well fleshed out. So far, most of the financing from the capital markets has come in the form of so-called green bonds, and these have been raised by the World Bank and other multilateral agencies. It's around $4 billion so far in green bonds out there, and it's expectation that in 2011 we could see up to $11 billion of green bonds and up to $30 billion by 2012. So it's really a growing market in terms of capital being raised from bond investors. But the thing about these green bonds is, so far, the risk-reward balance is very skewed towards sort of low risk. Not that that's a bad thing in itself, but low risk usually means low yield, and investors are looking for yield pickup in the current low inflationary environment. So if they could see structures with more of a transfer of risk, not excessively, but more of a transfer of risk, moving down the credit scale, maybe to sort of single A, triple B area, in what we see typically in project finance and public-private partnerships, I think there would be quite considerable appetite for that type of instrument. So it's just a question of us providing investors with the analysis of these types of instruments so that there's transparency out there. But clearly there is demand and there's appetite. It's just a question of satisfying that demand.
Right. So what about the outlook for carbon pricing and emissions trading in the US as well as in Europe and Asia Pacific?
Yeah, I mean, carbon markets have been evolving slowly and steadily over the past 5 years since they were set up in Europe in 2005 under the emissions trading scheme. The carbon price at Europe at the moment stands around 15 euros a tonne. It's been relatively stable over the past couple of years after sort of quite a significant volatility in the early stages. But the expectation now is that carbon prices will increase quite dramatically up to 2012 and beyond. And the reason for that is basically because the European Commission has put in place a much stricter climate package. Caps on emissions are going down. Allowances, which are the permits that companies have to buy to be able to pollute the atmosphere, those permits are going to be sold under auction conditions, and increasingly more and more sectors are being covered by the scheme. So while we'll see a price of around 15 euros a tonne now, the expectation out of the market is that will raise to around 20 euros a tonne by the end of this year. And then, we're moving into an era where we could see prices in Europe for carbon move up to maybe 70, 75 euros a tonne by 2020. And it's all to do with demand and supply and climate policy. It's very clear, we believe, that the European Commission wants to see the carbon price go up. And that's really to incentivize low carbon technology, to bring down emissions, and also basically to show that things like nuclear power, carbon capture and storage, all those types of low carbon technologies and generations that we need to bring down emissions actually needs to have a carbon price embedded before you get the right incentives. Other places in the world are struggling to set a carbon price. The US has not been able to adopt a climate change policy across the nation, although we're seeing progress happen in California. Most progress actually is happening in Asia, where we see a carbon price being developed in places like New Zealand, which started its cap and trade scheme in July of this year, and in Korea, Japan, and importantly China is now talking actively about having a domestic emissions trading scheme. But we're still about 5 years away from that happening, we believe, but it's moving in that direction.
Okay. Now, you've surveyed a lot of companies in Europe and Asia Pacific that are rated by Standard & Poor's to gauge their level of preparedness for a carbon price. A lot of the results are captured in a Credit Week special that you've published today. Right. But just talk us through some of the main implications and what you've learned from that exercise. Yeah,
we've undertaken 2 surveys during the course of this year of our rated issuers. So the first one was done back in March in Europe, where we asked around 500 companies how they felt about their risk to carbon exposure, how they were managing that risk, and also whether it had an impact on their fundraising. So far, in Europe at least, the impact has been fairly benign, but the respondents to our survey said that they expected post-2012 that they're going to face significant challenges because of, as I said earlier, the increasingly strict regime under the emissions trading scheme, and the expected price of carbon, which will go up, will put a financial burden on them and hence increase their liabilities. And we're talking about the utilities, metals and mining, oil refineries, chemicals, pulp and paper, cement, steel. Those are the sectors which are most involved or most affected by the carbon price. Right. Outside of Europe, we did a survey in Asia Pacific, and that was completed in October, fairly recently. The respondents to that survey had a kind of a different level of I suppose, preparedness for carbon strategies. And that's basically because Asia Pacific hasn't got a cap and trade scheme in place yet. As I said, there's one in New Zealand, but other countries in the region still have to embrace emissions trading as a way of setting a carbon price. So companies in Asia, I think, are still trying to work out what they should do. They know that climate change is going to have an impact on their business. In fact, over 2/3 of respondents said that they expected climate change to have a detrimental physical impact on their business. But there was some degree of, I suppose, confusion about how they should manage that risk, and also how they should prepare for what is inevitably going to be more and more restraints on their business because of carbon regulation. So it's a different picture that we see across the world in terms of companies being prepared for environmental risk.
Right, and the big question, of course, is what are the implications for credit quality?
Yeah, I mean, the implications for credit quality are bound to be discovered as we move into more strict environmental compliance regimes. Here in Europe, so far, the impact has been fairly muted, apart from in the utility sector, where we've seen some quite isolated incidents of rating actions driven by carbon exposure. But that's not to say that we don't expect things to change, and it's a question of to what degree and which companies will be impacted the most, and how material policy is going to be in terms of the impact on credit. And we're going through a process now where we're developing an analytical approach to analysing carbon exposure as part of our overall economic risk analysis, which then gets factored into ratings. So it's early days so far, but we know that it's an issue. And importantly, we hear from investors, the big pension funds also recognise that this is an issue. They're coming to us and asking us, what is the risk of our portfolio of carbon exposure? So that leads us to believe that we need to take this very seriously and create a transparent analytical methodology for taking this into account in ratings.
Okay, watch this space. Mike Wilkins, Global Head of Carbon Markets at Standard & Poor's. Thanks very much for joining us.